So you're trying to wrap your head around a company making a pretty big shift, right? Feels like there's just so much information out there and you want to cut through that noise.
Exactly. It can be overwhelming.
Well, that's what we aim to do here on the Deep Dive. Today, we're focusing on Bitfarms Ltd, that's NASDQ, and TSX, ticker BITF.
Right. And the big question really is this. Bitfarms was known for Bitcoin mining. Now they're pivoting hard into North American energy and compute infrastructure, betting big on HPC and AI. Is that a compelling value investment now?
It's a fundamental change, and to figure that out, we've really dug in. We've looked at investment analyses, earnings reports, news, regulatory filings.
The field works. Yeah, a lot of material. Our goal here is to pull out the most critical stuff, the insights you actually need to understand what's going on with Bitfarms.
We'll split this into two halves. First up, we'll get a grip on the business itself, operations, strategy, who's running the show, and crucially, their financial health.
Then in the second half, we'll look at, what the market thinks, who owns the stock, the big risks involved, and then try to pull it all together.
And hey, if this kind of deep dive helps you navigate these complex situations, just a reminder, members of Stock Analytics AI, that's Euro 4.99 a month, can request prioritized deep dives on specific tickers. Analysis like this, focused on what you want to understand. Okay, let's get into it.
Let's start with the basics. Bitfarms, founded back in 2017, initially a global Bitcoin self-miner.
Right, I remember them coming onto the scene.
Yeah, they listed on the TSX Venture in 2019, then NASDAQ in 2021. But now, their strategy has really evolved. They're calling themselves the North American Energy and Compute Infrastructure Company.
That's quite a mouthful. But it signals a huge shift. Taking that power management know-how from mining and applying it to HPC and AI data center.
Pretty much. It's a dramatic pivot. And there are a few key reasons behind it.
What's driving it? The mining economics, I assume.
That's a huge part of it, yeah. Bitcoin mining got a lot tougher, especially after the 2024 halving. The block reward dropped from 6.25 Bitcoin down to 3.125.
Halved, literally.
Exactly. And at the same time, the price miners get for their computing power, the hash price that took a nosedive too. Went from maybe 12 cents per terahash in April 24 down to around 5 cents a year later.
Ouch. That really puts the squeeze on profitability, doesn't it? Especially if your costs are high.
Absolutely. It compresses margins significantly. But then look at the other side. The demand for AI computation. It's just exploding.
Right. Training those huge models takes incredible power.
Incredible amounts. So companies like Bitfarms, who already know how to manage large-scale power infrastructure, they see an opportunity. They think they have transferable skills, maybe even existing assets they can leverage for this booming HPC AI market. Their mission now explicitly includes leading in HPC AI infrastructure with a focus on sustainable energy.
Okay, so how are they actually making money right now? And what's the plan for future revenue streams?
Well, currently, most of their revenue still comes from Bitcoin self-mining. Q1 2025, that was $65 million.
Even with the tougher economics.
Yeah. Interestingly, they mined fewer Bitcoin than the year before, like 693 versus 943. But the higher Bitcoin price helped offset that. But, and this is key, their gross mining margins shrank significantly, down to 43% from 63% year over year.
That's a big drop.
It is. And their direct cost to mine a Bitcoin, that jumped up to about $47,800. That rising cost per coin is really something you need to watch.
Definitely. A critical metric. What else is bringing in revenue?
They do some hosting for third-party miners, like Stronghold and Canaan. That brought in the equivalent of about 6 Bitcoin in Q1. Geographically, Canada's been big for them historically. Argentina chipped in about $6.9 million in Q1, roughly 10% of revenue.
But I heard something about issues in Argentina.
Yeah, that's right. There was a power outage there in May 2025 that halted operations. So that revenue stream is currently offline. It highlights the operational risks,
Absolutely. So what about the big hope, the HPC and AI revenue?
That's still in the future. Really, it's all in development right now, no revenue yet. The plan is to target enterprise clients, sign long-term contracts for these new data centers. But the facilities themselves, still being built.
So it's potential, not present income.
Exactly. Further down the line, they also see potential in energy trading and demand response services, especially with the assets they got from Stronghold, which operate in the PJM grid in the U.S.
Okay, so Bitcoin mining pays the bills now, but the whole story, the growth narrative, is HPC and AI. Let's talk infrastructure. What do they actually have and where are they going?
Right now, they've got 15 operational sites, 8 in Canada, that's about 170 megawatts, 2 in the U.S., 1 in Washington, 17.5 milligoe, plus the Pennsylvania sites from the Stronghold deal. The Argentina site was 58 milligoe, but like we said, offline currently. And they sold off their sites in Paraguay, including the Big Iguazu facility.
So a clear shift away from South America towards North America, particularly the U.S.
Definitely consolidation. Total energized capacity right now is about 461 megawatts.
And the target.
Ambitious. They're aiming for 1.4 gigawatts. That's a huge jump. And they want 80% of that to be in the U.S.
Wow. Okay. And on the mining side, hash rate, efficiency.
Current hash rate is around 19.5 exahash per second, and they have improved efficiency quite a bit, about 19 watts per terahash. That's like a 45% improvement year over year. Really important for offsetting those rising costs we talked about.
Crucial. What other energy sources? That's always a big question with mining and data centers.
Historically, they've said over 75% renewable, mostly hydro, especially in Canada and Paraguay. But things are changing. Selling Iguazu, which is all hydro, and buying Stronghold, which uses coal refuse power. That shifts the mix.
Coal refuse. How does that fit with sustainable?
Well, Stronghold argues using waste coal has some environmental benefits compared to letting it sit there. It's a complex argument, but it definitely changes their energy profile. Costs vary a lot. By site, they've had very low costs, like 2 cents per kilowatt hours in South America, under 3 cents in Washington. Stronghold forecasts maybe 3 to 4.5 cents in Pennsylvania.
And those costs feed into that high per Bitcoin cost figure.
Directly. That $47,800 direct cost and over $72,000 total cash cost per Bitcoin in Q1. Energy is a massive part of that, along with everything else.
And they try to control as much as possible in-house.
Yeah, vertical integration is key for them. In-house management, engineering, repairs, data analytics. They try to handle it all.
Okay, got the picture on operations. Let's dive into the strategy driving this whole transformation. The Stronghold acquisition sounds like the linchpin.
It really was. March 2025, that deal was absolutely pivotal for their U.S. strategy and the whole HPC AI plan. It brought them 165 megawatts of active power generation, another 142 mil-W of import capacity, and this huge 1.1 gigawatt growth pipeline in Pennsylvania.
A gigawatt pipeline that's massive.
It is. These Pennsylvania assets with all that power potential, that's the foundation for their HPC AI dream. It was a stock-for-stock deal, plus Bitfarms took on about $44.5 million of Stronghold's debt. The scale of power they acquired is really what they hope will attract those big HPC AI customers.
So the U.S. is absolutely central. Any other moves there?
Well, beyond Stronghold, they're also working on optimizing their existing Washington site. But yeah, the main goal is building a strong U.S. footprint. They see it as the best place for energy development and these high-tech data centers.
And where's the first big HPC AI build happening? What's the flagship?
That would be Panther Creek in Pennsylvania, one of the Stronghold sites. It's got potential for nearly 500 megawatts. Huge size, good location, power infrastructure already there, and importantly, low latency fiber connectivity. That's critical for HPC clients.
Right. Can't have slow connections.
Absolutely not. They expect to finalize the master plan for Panther Creek in Q2 2025 and hope to break ground in the second half of the year. The scale of Panther Creek really signals how big they're thinking in HPC AI.
Okay, a 500 mW facility is a serious undertaking. How are they paying for all this?
They secured a big debt facility up to $300 million from Macquarie Group. They've already drawn down an initial $50 million. Interest rate is 8%, and Macquarie also got warrants as part of the deal.
Warrants, okay. So dilutive eventually, potentially.
Potentially, yes. But management keeps saying they prefer debt over issuing more stock right now because it's seen as less immediately dilutive to current shareholders.
That makes sense for a company trying to fund growth. Are they bringing in outside help for the HPC AI side? It's a different world from mining?
They are. They've partnered with companies like Worldwide Technology, WWT, and ASG, basically bringing in expertise to help with the feasibility studies and the technical side of building out these sites, specifically for HPC and AI, shows they know they need specialized knowledge.
And selling the Paraguay facility, Iguazu, that fits the strategy too.
Exactly. Selling Iguazu to HIVE in March 2025 was about shedding a non-core asset. It freed up capital, which they say is going straight back into these U.S.-based HPC and energy projects. It underlines that laser focus on North America.
Okay, clear strategy then. Consolidate in the U.S., build massive power capacity, pivot to ride the AI wave. How do they stack up against competitors? First, in Bitcoin mining.
Well, in mining, like we said, it's tough post-halving. Everyone's feeling the pressure. Rising network hash rate means efficiency and low-cost power are everything. New ASICs are getting better, more efficient. Bitfarms at 19.5 exahash is a decent size, but they're up against giants like Marathon, Riot, Core Scientific, CleanSpark. Lots of competition.
In the HPC AI space, that's a whole different ballgame, isn't it?
Completely different. It's growing incredibly fast. Estimates put the global market near $74 billion by 2030. North American AI server market expected to explode. But the players, you've got established data center REITs like Equinix, Digital Realty. You've got the cloud hyperscalers, AWS, Azure, Google, plus specialized HPC guys like CoreWeave, Applied Digital, even other miners trying the same pivot.
That sounds incredibly crowded. What's Bitfarms' edge, their moat?
Their main potential advantage is that power infrastructure, what they own, what they're developing, especially from stronghold in the PJM market. Having control over large amounts of power, potentially at good costs, is a big deal.
The vertical integration helps too.
It could offer some cost efficiencies, yeah. But look, in HPC AI, that moat is still being dug. They have power potential, but they need to prove they can attract big enterprise clients, deliver reliable high-spec services. Power is just the start. You need cooling, connectivity, the whole package.
So a foundation, but a lot to build on top.
Exactly. They're smaller than some top miners, and they're the new kid on the block in HPC AI against giants with established relationships and deep pockets. It's capital intensive, needs that debt. There's huge execution risk in pulling off this pivot, and as we'll see, their current financials show they're losing money.
Okay, let's shift to the people leading this charge. What about the management team?
The CEO is Ben Gagnon. He's got a long history in Bitcoin mining, even founded his own operations before joining Bitfarms back in 2019. Held several roles there, biz dev, mining ops, CMO before becoming CEO in July 2024. Got a science background. His vision is clear. U.S. expansion, HPC AI for stable revenue.
And the finances. Who's managing the money side of this big pivot?
That's Jeffrey Lucas, the CFO. He's got, 30-plus years in international finance, tech, manufacturing. Joined Bitfarms in 2021, came from Mackinac Partners, was CFO at Imagine before that. Has an MBA. His focus seems to be getting cost-effective financing for the HPC AI build-out, pushing that preference for debt we mentioned.
And operations, handling mining and building data centers.
Liam Wilson is the COO. Over 20 years in operations, especially energy, involved in over $900 million of power deals. Importantly, he was COO at Mawson Infrastructure, which also focused on the U.S. and that PJM grid where Stronghold operates. So his background seems very relevant to what Bitfarms is trying to do now.
So on paper, the top team looks like they have relevant experience, but there have been some governance issues, right? That raises questions.
Yes, and this is a really critical point for investors, governance. In December 2024, Bitfarms had to announce major financial restatements, fiscal years 22 and 23, plus interim periods in 24.
Restatements are never good news. What went wrong?
Material errors. How they classify digital asset sales, basically. Were they operating or investing activities? And also errors in accounting for some warrant redemptions. These came up after an SEC review.
What was the impact? Did it change their cash balance?
No, the overall cash position wasn't affected. But it significantly changed how cash flows were reported. Operating cash flow for FY23 looked much worse after the restatement. And their net loss for FY23 actually increased because of the warrant accounting error. It definitely changes how you analyze their past performance.
And the fallout from that?
Well, they admitted it was due to weak internal controls over financial reporting, identified a material weakness. They have a plan to fix it, but fixing it got delayed, pushed out to later in 2025.
Delays aren't great either.
Not ideal. And predictably, these restatements led to shareholder lawsuits, allegations of misleading investors. Plus, they settled with their former CEO back in October 2024. All this, it does raise questions about management credibility and whether you can fully trust their forward-looking statements.
Definitely things potential investors need to weigh heavily. What about the board overseeing all this?
They have the standard committees, audit, compensation, ESG, governance, and nominating. Given the restatements, the audit committee's diligence is obviously crucial right now. CEO Gagnon is also on the board. Strong independent oversight is really vital to rebuild confidence after finding those material weaknesses.
So the structures are there, but effectiveness is key.
Exactly. They have codes of conduct, whistleblower policies, the usual stuff. But the fact that material errors happened suggests, gaps in how those policies and controls were actually working in practice.
Okay. Shifting to how they spend their money, capital allocation. What are the priorities?
It's crystal clear. HPC and AI infrastructure development.
Yeah.
Management literally said no plans for additional large miner purchases for 2025 or 2026. Non-HPC CapEx this year, under $100 million, mostly just maintaining existing mining gear. The money's flowing to the pivot.
And funding it. We know about the Macquarie debt. Anything else?
Debt is preferred, like we said, to avoid dilution. They have used their at-the-market equity program, raised about $24 million net back in January 25, but they haven't used it since then, up to mid-May anyway. They used it quite a bit in 2024, though. And don't forget the cash coming in from selling the Iguazu site in Paraguay that's being plowed back into the U.S. projects. About $26 million expected from HIVE over 5 months.
How efficiently are they using the capital they've already put to work? What's the ROIC look like?
Not good right now. Return on invested capital for Q1 2025 was negative 34.8%. That really underlines that they're not profitable on their investments yet. The big HPCAI spending hasn't started generating returns. Management says maximizing ROIC through HPCAI is the long-term goal.
And returning cash to shareholders? Dividends? Buybacks?
No dividends. Pretty standard for a company in growth mode or losing money. They reinvest everything back into the business. No recent formal share buyback program either. They did buy back some Bitcoin from Bitmain in January 25 as part of a minor upgrade deal, but that wasn't really returning capital to shareholders.
So all capital is focused on funding the pivot, mainly via debt and asset sales for now. Let's drill down into the financial health based on recent reports. What are the numbers telling us?
Well, there is revenue growth. Q1 25 revenue was $66.8 million, up 33% year over year. Similar growth in Q4 24 and for the full year 24. But as we keep saying, profitability is the issue. That gross mining margin decline is stark. They actually had a gross loss from mining in Q1 25, about $500,000.
Or a gross loss.
Yeah.
Oh.
And operating losses, net losses, they're ongoing. They had a blip of net income in Q4 24, but generally profitability is a major challenge. Even adjusted EBITDA, while positive, was down year over year in Q1 25.
And rising costs are hitting hard.
Hugely. Direct cost per Bitcoin surged.
Yeah.
Total cash cost per Bitcoin surged. G&A expenses are also climbing. It's all putting immense pressure on the core mining business.
What about the balance sheet, assets versus liabilities?
As of March 31st, 2025, total assets were $777 million, up quite a bit from year-end 24, probably reflecting the Stronghold deal. They hold a decent chunk in digital assets, 11,166 Bitcoin, worth around $94 million in late April. Property, plant, and equipment is substantial, again, thanks to Stronghold. Cash was about $73 million end of Q1. They claimed liquidity around $150 million mid-May, counting cash, BTC, and expected Iguazu payments.
And liabilities?
Total liabilities increased to $112 million, up from about $60 million, mainly due to drawing on that Macquarie debt. Equity also rose to $665 million, largely from shares issued for Stronghold. Their current ratio looks strong, almost 5.9, suggesting good short-term liquidity.
Yeah, this is a worry. Cash flow from operations was negative $18.6 million in Q1 25, and it was significantly negative for FY24 after those restatements. That means the core mining business isn't generating cash right now.
Not good. Not good at all. Investing activities show CapEx for the build-out, and they sold 428 Bitcoin for about $37 million in Q1. Financing activities show that $24 million net inflow from the ATM program in Q1 and likely the Macquarie debt draw. All this means free cash flow was negative $66.4 million in Q1 2025. They are definitely burning cash.
Okay, those numbers paint a tough picture financially during this transition. What about key ratios investors look at?
Profitability ratios are all negative right now. Gross margin, operating margin, net margin. Except for the gross mining margin, which is 43%, but that's down sharply. Liquidity, like the current ratio, looks okay short-term. Solvency, debt to equity around 0.17, seems manageable for now, but that debt will rise. Interest coverage is negative because they have operating losses. Efficiency ratios like asset turnover are low, typical for capital-intensive businesses before assets ramp up revenue, and return metrics, ROE, ROA, ROIC, all deeply negative right now.
So financially, it doesn't scream value investment yet. How is the market valuing them?
Well, around mid-May, the stock was about 115 cents. Market cap, roughly $639 million. Price to sales TTM was about 3.3. Price to book was just under 1, around 0.96. No meaningful PE because no earnings. Enterprise value around $567 million. EV to adjusted EBITDA TTM was about 10.4.
What does that valuation tell you?
It suggests the market is pricing in a lot of risk and uncertainty around the pivot, but also maybe some hope for that HPC-AI upside if they pull it off.
If we try to look at it qualitatively, like Warren Buffett-style understandable business, moat management, financials, margin of safety, what's the takeaway?
It's complex. The old mining business is understandable, but this pivot into HPC-AI, much more complex, high execution risk. Their moat in mining was maybe low-cost power, but that's always competitive. The potential HPC-AI moat from power assets, it's unproven, still being built. Management integrity, the restatements raise flags. Financial strength, weak right now losses, cash burn, taking on debt. So even with a low share price, finding a clear margin of safety is really tough because the risks are so high. Feels much more speculative than value at this point.
Okay, we've got a deep understanding of the business, the leadership, the financials. Let's look outward now. How is the market actually feeling about Bitfarms? What's the sentiment?
Analyst ratings are generally quite positive, actually. The consensus is strong buy.
Hmm?
Average price targets are up around $4.30 to $4.80. That suggests analysts see significant potential upside from where the stock is trading now.
That's a pretty bullish consensus. What are they seeing? And are there bears out there?
The bulls are focused on that HPC-AI growth story, definitely. They think the market might be undervaluing the existing mining assets, and they like the miner upgrades, improving efficiency. Getting the Macquarie debt deal done was also seen as a positive sign for funding the expansion.
But the bears.
Oh yeah, there are concerns. Declining EBITDA, the ongoing net losses, just the general volatility of crypto, and then the big ones. The execution risk of this pivot, the costs involved, can they really pull it off in such a competitive market? And the Q1 earnings miss didn't help, stock dropped, showing how sensitive the market is to their performance right now.
So a real tension between future hopes and current reality. What about short interest? Options activity.
It's interesting. Some data sources show pretty high short interest, like over 12% of the float shorted, with high borrowing costs. That suggests strong conviction from bears. But other sources show much lower short interest. So there's even disagreement on how heavily it's being shorted.
Conflicting data.
Yeah, it highlights the uncertainty. Options activity is definitely high, though. Lots of calls and puts being traded at various strikes, expiring from near term out to January 2026. Shows a wide range of bets and hedging going on.
And general news flow, media coverage, mixed bag.
Very much a mixed bag. Positive stories about the HPCI strategy and progress, but also negative coverage on the financial losses, the mining pressures, the governance issues we talked about, the execution risks. Recent news focused on Q1 earnings, that Argentina power outage, HPC updates, and the ongoing restatement lawsuits. Stock's been volatile, reflecting all that mixed sentiment.
Okay, so market sentiment is kind of all over the place. Let's look at who actually owns the stock. Ownership structure.
Institutional ownership is moderate. One source puts it around 22%, not counting major activist-type filings. Some known names hold positions: MMCP, Van Eck with their crypto ETFs like DAPP and BLOC, Invesco's WGMI ETF, Vident, UBS. So there's definitely some professional money involved.
What about insiders? Buying or selling?
Not much recent open market activity reported. Last 3 months, last 12 months. Pretty quiet, according to standard sources. Now, Bitfarms is a foreign private issuer, an FPI, so their SEC filing requirements for insiders might be different, less frequent maybe, than U.S. companies. Something to keep in mind.
Right. And we absolutely have to talk about Riot Platforms, their big stake, the history. What's the latest there?
Yeah, Riot, a major mining competitor, is the largest shareholder. They own about 16.3% of Bitfarms. Remember, Riot tried to buy Bitfarms back in 2023, early 24, but it didn't happen. Bitfarms even adopted a poison pill defense, which got cease-traded. Riot also pushed for their own board nominees.
So quite adversarial.
It was. There was a settlement agreement in September 24. But Riot's still there, still the biggest owner. And just recently, April 2025, there was this interesting waiver and proxy agreement. Basically, Riot's voting power is capped at 9.9%, even though they own 16.3%. That cap lifts if their ownership drops below 9.9%.
Why would Bitfarms agree to that?
Hard to say for sure, maybe part of ongoing negotiations or strategy. But Riot hasn't been quiet. They've publicly said Bitfarms needs urgently needed change, especially on the board and governance. So you've got this potentially tense dynamic between the company and its largest shareholder. Adds another layer of complexity.
Definitely something investors need to factor in. Okay, let's try to structure the risks. We've touched on many, but let's consolidate. Industry risks first.
Sure. Industry-wide, you've got Bitcoin price swings, network volatility, the ongoing impact of the halving on miner economics, intense competition both in mining and now HPC-AI, technology changing fast, ASICs, HPC gear, and always energy costs and availability. That Argentina outage is a perfect example.
Right.
Plus, the regulatory landscape for crypto and energy is always shifting.
And company-specific risks for Bitfarms.
Huge ones. Execution risk on the HPC AI pivot is probably number one. Can they actually build it, get customers, make it profitable? Financial health is a major concern. The cash burn, the need for more capital, the debt load. Governance issues are still lingering. The restatements, the material weakness, the lawsuits, the delay in fixing controls. That impacts credibility. Potential customer concentration risk if they land only a few big HPC deals. And reliance on key people is always a risk.
What about bigger picture regulatory geopolitical stuff?
Yeah, regulations specifically targeting crypto or maybe AI data centers could emerge. Geopolitical instability, like we saw in Argentina, can hit operations. Currency fluctuations, too, since they operate internationally and might get HPC revenue in different currencies.
And the potential U.S. tariffs in 2025, that seems highly relevant to their U.S. build-out.
Very relevant. If tariffs hit imported electronics like servers, mining hardware, or even data center construction materials, that could seriously hike up Bitfarms' costs. It could squeeze profitability for both mining and HPC AI, maybe delay their plans, make them less competitive versus non-US players.
Has management addressed this?
Management has said they expect minimal impact, but broader industry analysis suggests cost pressures are likely if these tariffs happen. That discrepancy is something you really need to watch. See how it actually plays out for them financially.
Good point. Finally, ESG risks. Environment, social, governance.
Environmentally, energy consumption is the big one for mining and AI centers. Using coal refuse power via Stronghold complicates their sustainable energy story. Socially, community impacts matter.
And governance, well, we've covered that the restatements, controls, lawsuits, all major ESG red flags that need monitoring.
Okay, we have covered a ton of ground on Bitfarms. Let's try to wrap this deep dive up. Key takeaways, final thoughts. Look, the summary is this. Bitfarms is making a really bold, ambitious pivot. Moving from Bitcoin mining to this North American energy and compute focus, betting heavily on HPC AI. They do have potential advantages, especially with those power assets. But the risks are massive. Execution risk, financial health, governance concerns, external factors like tariffs, crypto volatility. It's a long list.
So even though some analysts are bullish and the stock price looks low compared to targets, it's definitely not a simple buy the dip situation.
Not at all. It's highly speculative right now. That margin of safety investors look for, it's just not obvious here, given all the intertwined risks. If you're considering this, you need to watch several things, like a hawk. Real progress on HPCI contracts, build out. Any signs of improved governance and reporting, their financial performance, especially cash flow, the actual impact of tariffs, if they happen, and just basic operational stability.
So the final thought for you, the listener, is really this. Is Bitfarms' huge pivot a high-stakes gamble that could pay off massively in the booming AI world? Or is it just too risky entering crowded, expensive markets, especially with those past governance issues hanging over them? You really need to dig into the details of any HPC contracts they announce and watch how their financials evolve.
And if this kind of detailed breakdown helps you understand these complex investment stories, and you want more analysis like this, well, consider subscribing to SOC Analytics AI on YouTube. We do these deep dives regularly.
Thanks for joining us for this deep dive into Bitfarms.
And just a reminder, all this analysis is based on information we had up to May 18th, 2025. Things change fast in the markets.
Absolutely. Please, always do your own thorough research. And it's always a good idea to talk to a qualified financial advisor before making any investment decisions.
Finally, this discussion was for informational purposes only. We use data analysis, sometimes AI tools, but nothing here should be taken as financial advice or a recommendation to buy or sell Bitfarms or any other security.